Hi everyone, it's MJ, the fellow actuary, and in this video, I want to talk about crypto exchanges, especially the counterparty and systemic risk that we're seeing being played out after this demise of FTX. I also want to talk a little bit about how this mirrors what we saw with insurance companies, especially in the early days of their history, as well as looking at some trading techniques that you can take on during these uncertain times so that you have the best chance of, trying to get a profit with all the chaos. So for those of you who don't know, one of the very big exchanges does not have enough liquidity in order to meet the withdrawals. And this is causing a huge issue in the crypto market because it means people who have put money on these platforms are unable to withdraw it. And of course, this is always the big fear when interacting with a counterparty, is that they fail to uphold their end of the bargain. So the whole idea with the crypto exchange is that you deposit money in, you trade the various tokens, and whenever you want to withdraw your money back into fiat or back into your crypto wallet, they will have enough tokens on hand to meet that request. However, what's happened with FTX is that they're unable to do that, and they have now frozen a whole bunch of withdrawals, causing a lot of people to freak out. And what it does is, not only is it just a counterparty risk of all the people who have deposited money into FTX not being able to get their money out of it, it creates a systemic risk because now everyone in the crypto industry or everyone with crypto assets is thinking, wow, maybe the other exchanges are also not in the best position to meet, any withdrawals that I'm trying to make. And like I say, it's something similar that we see in the current banking system, where when people deposit money into the banks don't keep a one-to-one, reserve for their deposits. Instead, they make out loans, fractional reserving, all that kind of stuff, which can create a big problem. If there's a bank run, everybody wants to withdraw their money at the same time. The bank doesn't have enough money, and the same happens with these crypto exchanges. And what can happen with FTX is have a domino effect on all the other exchanges, that even though they might not be in such a bad position, everybody wanting to withdraw at the same time, they might not have that liquidity in order to meet it. And hence we're seeing the whole crypto market tank, as a lot of people are now, a fear has infected already. We're in a big bear market, and we've just had crazy events with Luna and Celsius already this year. So 2022 has been a bit of a bad one for the crypto industry. But essentially what this means is a lot of people out of fear are trying to withdraw and putting on a lot of pressure on these crypto exchanges. And now, these crypto exchanges are going through these liquidity squeezes, and it's going to be really, scary. But hopefully, some of the bigger ones can make it through. But what I want to do is talk a little bit about how this is similar to the history of insurance. Insurance is a little bit more complicated than a crypto exchange, in the sense that the time flow or the timing of the cash flows are not only uncertain, but they also have a big duration between the two. So very quickly, insurance, you pay your premiums now, and if a risk event occurs in the future, you are hoping that the insurance company will meet that benefit. However, what happened in the early days is one of two things could have happened. One, the insurance company got all of these premiums, saw all of this money and said, thank you very much, and went off and spent it. And it was kind of like, downright fraud, big heist. But the other situation was when they just simply didn't calculate the premium correctly, or they didn't hold enough reserves on hand, so the benefits exceeded it, and this ruin event occurred where they were unable to meet the claims. And of course, this is detrimental because people had paid these premiums to have that security, to have that cover, and when they now need it, it's not there. And this is where actuaries actually got involved, because an actuary was set up and gave the power by the regulator to be the person who says, no, this insurance company actually has the reserves on hand to meet the benefits in the future, given a certain confidence level. So actuaries were part of the regulation that ensured that insurance companies had enough capital on hand in order to meet benefits in the future. Crypto, on the other hand, It's one of they don't call it a bug, they call it a feature, that there is no regulation. There is no actuary kind of saying, hey, the amount of reserves that this exchange is holding is enough to meet, withdrawals and, these various events with a certain degree of confidence. In fact, it's only now that we're trying to get a little bit of transparency on what these reserves of these crypto exchanges are actually holding. So now I'm actually thinking in the future, we're going to see a form of regulation, might not be coming from a government or central authority, because of course that is very anti, the whole philosophy of crypto, but we could see some self-regulation happening. So what's going to happen is some of the big exchanges are going to show that they've got enough reserves. They're going to get in financial professionals or risk professionals, potentially actuaries, to show that they have enough reserves to meet various risk events. And they're going to do this voluntarily in order to get the public support, because I think the public now is very, very wary of these crypto exchanges and the fact that, hey, you put your money into these put your money into these exchanges, they might not hold enough reserves for when you come to withdraw it. Now, I want to just end off this video by talking about what are some trading strategies that you can do during these chaotic events. So something I like to do during these things is to pick two tokens, a token that you really, really like and a token that you really, really don't like. So for me, a token that I love is Polygon, the Matic token. I used to work there. And then a token that I just don't like is Solana, just because they've had quite a lot of, halts during the time, and also there's a bit of a connection there with FTX. But essentially what you want to do is do your own research, pick two stocks or two tokens that you one you like, one that you don't like, and then what you do is you long the one token that you like. Long means you're buying it, but you use a derivative, maybe times 5, whatever type of exposure you want. And then the one that you don't like, you short it. So that means you make money if the price goes down. And now what's going to happen in this situation, or why you want to use this type of strategy, is we do know that the crypto market is very much correlated, so they think coins tend to go up together and coins tend to come down together. And what you're effectively doing with the strategy is, if the tokens go up and you correctly chose a better token than the other one, and that one goes up a little bit more than the other, your long contract is going to make more money than what your short contract loses. On the other hand, if the whole crypto market goes down, the theory is that your good token will go down less than the bad token, which will go down more, which means you'll make more money on the short contract than what you'll lose on the long contract. And that's just one potential strategy that you can use during these very, very volatile times. Yes, there's reverse butterfly spreads and all these other type of things that are a little bit more complicated, but essentially you look at the market, it does have a high correlation with itself, and therefore you want to say, okay, I want one that when it goes up, it's going to go up more than all the others, or when it goes down, I want to pick another one that's going to go down more than all the others. So this is a great time for, there's that common, the shit token, excuse my French on that. This is a time where if you really don't like a token, get in those short contracts. But like I say, make sure you've got a really solid token that you can balance it out on the long. If you want to know more about how to actually do this, check out my previous video called Fundamental Analysis for Crypto Traders, where I know it's a really long video, but right towards the end, I do have a demonstration on how to enter in to these various derivative contracts. Of course, high risk, so do your own research before you play around with them, but one thing that you can do during these uncertain times. Anyway, thanks so much for watching, and let me know if you have any thoughts or questions down in the comment section below. Cheers.